All right, my clock says 3 o'clock, so I'm going to go ahead and get going. Welcome. For those of you who don't know me, my name is Tim Hilgis. I'm a shareholder at Clayton McCurvey, and this is our 6th webinar on the Payroll Protection Program loan. Sarah, Ben, and myself have kind of lived and breathed this every day since March 27th, when the president signed the bill, all the way through the 48 frequently asked questions and the 15 interim final rules. And for those of you who aren't aware of it, treasury.gov is a great website for you to kind of see if there's been any changes. It's a pretty good resource. It's also where you can find the SBA's application form for forgiveness, as well as the application for, or example of the application for the loan. One of the things that we've been trying to do every week is make sure we're on top of all the changes that have occurred. As I said, our firm's been working on this area significantly since the end of March. For those of you who are not familiar with our firm, what Ben and Sarah and myself do every day is we pretty much work with closely held businesses. That's the nature of our firm. It's been that way for over 40 years. We do have a strong concentration of international clients, and for those of you that are online, you'll know that we dealt with many of you with question 44 and of course some of the interim final rules that changed some of the rules for you between March 4th and March 5th applications. A little bit of homework for you, or a little bit of housework for you. We typically end these seminars right at 4 o'clock. I'm going to kind of look for a show of hands. We've had so many questions over the weeks. And so if I could just see a show of hands, what we were thinking about is, because there hasn't been a lot of changes from last week, is kind of go through some specific areas that are special or that we want to talk about with relationship to the House bill, some things related to our website and information. So Sarah, Ben, and myself will kind of share some updates, and then we're going to go directly to your questions this week. And we're thinking that it might be more efficient and maybe even better for you if you hear us banter or discuss these questions specifically, as opposed to what we've done in the past is Ben or Sarah or myself, depending on who's speaking or who's not speaking, is answering those questions live. And we've typically stayed online after 4 o'clock. I think our first time Sarah and I stayed on almost 2 hours answering questions after the first webinar. And so we wanted to try to probably maybe bring those more to a live interaction. Now, we don't get to see you, so I was kind of jokingly say, let me see a raise of hands, how many people are okay with us going a little bit past 4 o'clock. The thing I'll tell you is if you gotta log off, that's fine. I think hopefully you've seen we post these live streams for you to review later. We also post the questions later, so hopefully you'll get a chance to check in on some of those questions if by chance you have to check out at 4 o'clock. We certainly know you guys all run businesses, and that was kind of the commitment that I inherited from one of my partners, Jim Beal, years ago when I used to do the CFO roundtables, was you got to keep that commitment to end on time so people know when they can make their next appointment. So we're going to keep that going. Now, as far as next week goes, so we asked you last time to go ahead and save the date for next Wednesday, 3 o'clock. Our anticipation would be to be consistent with this kind of Q&A format, unless, and that's a big unless, if we see some action in Congress. So as you know, and Sarah's going to talk a little bit about the House bill that passed, but with much anticipation, we'd love to see the Senate come to some conclusion on this and perhaps even see the president sign a new law in place. And if that happens before next Wednesday, that will dominate the presentation. We'll still continue to do Q&As afterwards or continue to stay online and do question and answers. And we've talked about this. This will be kind of an open discussion, or maybe not an open discussion, but within our office. Should we consider going to an hour and a half next week if we get good results or we feel that the Q&A was successful today? Do we have some strong content from Sarah on any law changes that occur and still continue on and maybe go to 4:30 next week with some Q&A? So that being said, I have one thing for those of you who were on last week. I opened my mouth, and you know, when I open my mouth, there's a 50-50 chance that I know what I'm talking about. And I see Ben and Sarah are smiling, and they caught me this time on the 50% where I didn't know what I was talking about. And I'm not going to justify that I was right all the way until like May 21st, but what changed in the 14th IFR, for those of you who remember, I was asked the question, about if compensation that was eligible for forgiveness was limited in any way. And at what was originally the case was the only limitation for owners was related to self-employeds and to partner owners. And what changed in the 14th IFR was that they used this term owner employee, and that's covering everybody. So that's your C Corps, your S Corps, your partnerships, and your sole practitioner. So you will have that limitation of what you paid in 2019 as a limiter for the amount that can be forgiven up to that annualized payroll amount of $15,385. So I was wrong, they were right, and I'm never going to talk again on these webinars. So you'll never have to face that 50-50 guess on whether or not what I've told you is right or wrong. Other thing I wanted to let you know, we haven't faced too many questions. A few bankers have asked this question, but we'll probably spend about 10 minutes next Wednesday. I'll spend 10 minutes next Wednesday covering some of the accounting options that you might have. For the most part, you're pretty limited. I'm not going to get into too much detail, but there are, whether we have people who are under international accounting standards, not-for-profit accounting, or good old generally accepted accounting principles, we'll talk about what your options are for the accounting on this. I would encourage you to look at our website and look at some of the resources we have there, and we'll talk a little bit about those. But I think I covered my 6 minutes of 50% right. So 50% of what I said in that 6 minutes is going to actually be true. The other 50% you're going to have to wonder. I'm just kidding. So let's turn it over to Sarah, and Sarah can go ahead and give us a little bit of update on what's going on.
Thanks, Tim. Don't beat yourself up too hard. For those of you who have been with us since the very beginning, there was a point in time where I was also wrong.
Oops, hold on. There's a possibility if Ben says the same thing, there's nothing anybody can rely on. So let's just stop with you and I. Everything Ben says is correct. Let's just leave it there.
I too owned up to, I had made an assumption on the rule and thought that the expenses would in fact be deductible before the IRS came out and shut my opinion down and said, no, they in fact won't be deductible if they're forgiven. I also owned up to my mistake once that rule was made clear to me. So
there's one way that you could then become right. Everybody listening reaches out to their congressperson and their senators, because this is important. We originally heard some people barking, some congressmen and senators saying we want those to be deductible, and now we haven't heard much. So definitely, if you want to think about the next phone call you could make thinking about an impact to your business, it would be that all of this forgiveness ends up still resulting in fully deductible expenses.
Yep, I agree. I've already reached out to both my senator and House and representative on this issue in hopes that it will get included in whatever the next bill is that comes through. Before I get into the House bill, I just wanted to give you my weekly update on where we stand with the PPP program today. We have yet again, the net approved dollars has decreased again. I think this is the third week in a row those dollars have decreased. I think it decreased by about $3 billion compared to the statistics I gave you last week, although the loan count has gone up. So this is indicating that there continues to be some of these larger loans that people are returning. I think there's also been some issues with the way the SBA was accumulating data. They've realized that they were duplicating some of the loans in their net approved dollars. And that just sort of speaks to how many loans they've processed in this short period of time and their capacity to do that. I think that these numbers get more and more accurate. But, looking at this, there's still about $130 billion left in this loan program. So plenty of small businesses still have access to these funds. If we look at, for those of you wondering, in these new numbers, what percent is over that $2 million threshold for those of you who have loans over $2 million, it's still just under 1%. That percentage hasn't changed from the last 2 weeks. It's been floating around 0.75%. and the average loan size as of Sunday was $114,000. That's up just slightly compared to the numbers I gave you last week, but that's where we stand today. So I wanted to get into the proposed legislation. We talked a little bit about this last week, but it had not yet passed the bill, or it had not yet passed the House. What actually ended up getting passed in the House of Representatives is slightly different than what we talked about yesterday. And I think that that is a result of trying to get a more bipartisan bill, so to make it easier to get this legislation passed. When the House voted, the vote was 417-1. So pretty bipartisan support for this act. What it does is extends the covered period from 8 weeks to 24 weeks after the date of origination, or December 31st, 2020, whichever is earlier. So if December 31st, 2020 is less than 24 weeks, that's when your covered period would end. This act has not yet passed the Senate, so it is not yet a bill. These provisions are not yet in effect. There's a limitation on forgiveness. In order to receive loan forgiveness, at least 60% must be spent on payroll. So unlike the rule that we have today, which says that the amount eligible for forgiveness is limited, at least 75% of the amount eligible for forgiveness must be spent on payroll. This legislation imposes an all or nothing. If you don't reach that 60% payroll threshold, you will get zero loan forgiveness. This was a sticking point, and I think initially one of the reasons why they hadn't put this on the docket for a vote when they came back into session on Monday in the Senate. Marco Rubio came out and said, hey, I'm talking with the Treasury to see if this is going to be, this is our interpretation, this all or nothing. I want to talk with the Treasury to see if it is also their interpretation, or if they can make any adjustments to this in their implementation of the rule. And the Treasury came back and said, that is our interpretation, and we would not have the authority to change it the way the legislation is written. So if this bill does get passed, it will be an all or nothing. You will need to spend at least 60% of your total payroll protection loan on payroll in order to get any forgiveness. Now, Marco Rubio did come back and say, okay, I can live with it because the time to spend the funds is extended to 24 weeks. So most small businesses, since the loan is based on only 2.5 months of payroll, most small businesses should not have an issue reaching that 60% threshold to get full forgiveness. So we'll see if this ends up changing, and I'll talk a little bit about what's going on right now in a couple of minutes. The other items that were included in this proposed legislation is it amends the term of the loan to be a minimum of 5 years from the 2-year maturity imposed by the administrator. This will require your banks to issue amendments to the current loan documents. That shouldn't be too difficult, but there will need to be amendments to put that provision into place. And then we talked a little bit about, there was a carve out in the exception to the FTE reduction. The original drafted legislation that was pretty broad, and it said if the business is able to demonstrate an ability to return to the same level of business activity, there could be an exception. The legislation that got passed actually expanded on that a little bit and sort of indicated that if you couldn't hire all of your employees back due to CDC requirements, OSHA requirements, guidance by the health and welfare, security, all of these things. If you're one of these businesses that, a restaurant that can only be at 50% capacity, I think this is what they're getting at, and that is the reason why you cannot rehire all of your employees by this December 31st deadline. You would get an exception. TBD on what that proof would look like. And then again, the other thing that's included in here is it allows loan recipients to benefit from that payroll tax deferment that's included in the CARES Act, even if the loan is forgiven. Currently, the law is that you can benefit from this payroll tax deferment until you know that your loan has been forgiven. So you should still be taking advantage if you want to of that payroll tax deferment. We'll see if we get that expanded so that everybody gets to take advantage of it even after their loan is forgiven. So I said I would talk a little bit about what's going on in the Senate. Both McConnell and Marco Rubio, who is sort of the chair on the Small Business Committee, have said that, while they recognize that this legislation isn't perfect, they want to pass it. They think that they should they're trying to fast track it. But McConnell is trying to do this in a manner in which there's unanimous consent. He does not want to spend floor time debating this legislation. He doesn't want people out there taking up a bunch of time that, they've sort of carved out this period of Congress to talk about certain appointments, judicial nominations, and a couple of other pieces of legislation that they have as priority. And he doesn't want to use time away from those things to vote on this act and to debate this act. So he wants unanimous consent. However, there are two senators, Mike Lee from Utah and Ron Johnson from Wisconsin, who are holding this up because they want the program to expire in August rather than December, which is why they have yet to vote on this bill in the Senate. I think McConnell and Rubio are in the background trying to convince them why getting this bill passed sooner rather than later makes the most sense. The original Senate bill that was out there before they took their 1-week recess last week had only extended the cover period from 8 to 16 weeks. And these two senators are saying that's the right amount of time, and we don't want to vote on this bill that extends it to December 31st, 2020. My hunch is there's some political, negotiations going on in the background. They probably want something to cave in. We'll see where this lands. I'm really hoping that they're able to vote on it sometime this week so that by the time we get to next week's session, we can talk a little bit more about this. It'll certainly bring up a whole new set of hypotheticals, and we'll see how fast it is before the SBA responds to guidance if this bill does get passed. There's been no recent SBA guidance. The last FAQ, which was really more for lenders, was issued on May 27th. And before that, there has been no interim final rules passed since May 22nd, since right before Memorial Day. So it's been a while since we've gotten anything from the SBA or Treasury. I think they're sitting tight, waiting to see what happens with this act. There was a lot of hope that it was going to pass pretty quickly once the Senate got back in session. And it seems that these two senators are the ones that are holding it up. One of the things Marco Rubio said is, the longer we wait, the less beneficial that this act gives us, or that it is for lender or for the borrowers. There's a National Federation of Independent Business survey that found 7% of borrowers, their 8-week window has already passed. And that was as of yesterday. 23% will have their deadline next week, and 19% the week after. So time is really critical for getting this passed, and I think everybody recognizes it, which is why yesterday Rubio sort of conceded on this 60% rule and said, what we've got is better off. We're better off passing what we have than not passing it at all. And the problem with changing this legislation in any way is that it will need to go back to the House for another vote. And currently the House is on recess, and they are not expected to come back into session for voting until June 30th, which would be way too late for most borrowers to be able to make real good business decisions with this proposed legislation. So with that, we'll sort of talk about your questions on the previous guidance. We'll revisit that a little bit. Tim had mentioned that we came to a resolution on what we, this concept of employer owner compensation that we had disagreed on. I'm happy to say that Ben and I were on the right side of that this time. Maybe next time Tim will be on the right side of it.
I don't know. I think I just want to be the antagonist. I feel like that I'll be, oh boy, I shouldn't say, I was going to say, to whoever you are out there, I'll be the CNN or the Fox. You decide which side I am. I'll be the antagonist to Ben and Sarah's neutrality.
Yeah. Before we get into Q&A, just I wanted to remind everyone on something that we discussed pretty briefly last session. The CARES Act had provided lenders 60 days to make a determination on loan forgiveness, and it was widely assumed that borrowers would know how much of their loan would be forgiven within that 60 days, because that was sort of the guidance that was provided in the CARES Act. The guidance that was issued on loan forgiveness, however, it indicates that borrowers have 60 days to submit their determination to the SBA for review. And then the SBA has 150 days to issue their final determination. So for borrowers, this means that it is possible, it could be 6 months from the time you submit an application for loan forgiveness before you know how much loan is forgiven or what that determination is on your application. So I wanted, we sort of covered that pretty quickly last week with everything else that happened with the loan forgiveness application. And so I sort of wanted to circle back on that and remind everybody and sort of point that timing out, because I think that it's a lot different than what we were originally assuming, it being that 60-day mark.
Mm-hmm. Sarah, I'm going to interrupt you just for a second, because I forgot one housekeeping item, and that was to make sure. I see some people have identified what's called the upvotes in the question section. Ben may have been doing what I was doing, which is kind of scrolling through. We have a lot of questions that are very similar to each other. So if you weren't familiar with this option, if you see a question that relates to your circumstance or you'd like to know the answer, there's a little triangle on the right side of that question. Might start with 0, but if you click on that triangle, it'll let us sort those by importance. So that really helps us now hopefully address the most important questions. But having read through these while you were kind of given some background, I think it'll be important to let everybody know that just like what we faced with the original legislation on March 27th, with now 15 interim final rules and 48 frequently asked questions, some of these questions that you have right now, how this 24-week changes things, are probably going to be coming again through the interim final rules, because we already know we can't answer some of these questions based on the law as it's written. So there'll be that, what we call the de minimis authority of the Treasury and SBA to then interpret or to put kind of the rules together. So I just wanted to make sure everybody's aware that, this opportunity for many companies to extend this period from 8 weeks to 24 weeks is going to be for a lot of businesses a blessing, especially if they've been in this field where they couldn't get their employees back to work. Perhaps they're in a non-essential or frankly a closed business at this point. It's going to give them more opportunity to get forgiveness, but we still don't know exactly what the math might look like. Fair to say, Sarah?
That's fair to say. And I think, one important thing to remember, so I've had a couple of conversations with clients about this, and they were like, well, so does that mean that I'll get 24 weeks worth of payroll completely forgiven? Your forgiveness is going to be limited to the amount of loan you got. That will be the maximum amount of forgiveness you can get. And that loan is based on only 2.5 months of payroll. So the most amount of payroll forgiveness you'll get is going to be that 2.5 month number. It just gives you a much longer time to spend that 2.5 months of payroll. Instead of it being 8 weeks, you get 24 weeks in the event that this passes. But it won't mean that all of a sudden all of your payroll gets forgiveness, because you will still be capped by the amount of your loan.
Okay. Let me, Ben, did you want to, let me just kind of bring Ben in for a second. So Ben, obviously we put some resources on our website that people can take advantage of. What's your plan? Or maybe you can just spend a minute or two talking about what you'd think would change with respect to the resources we have and how this legislation could change the information available.
Sure, yeah. So I spent about 10 or 15 minutes last week walking through a workbook that we have that calculates people's loan forgiveness. That workbook is available out on our website, and we also clipped out that explanation and put that right next to the workbook for your use. Nothing has been updated in that workbook for the pending changes that might come through the Flexibility Act, but that is definitely something that's on our radar, and we will make changes once that bill actually gets passed, and depending on what is actually in the bill. So right now, I would think that we probably have to build in checks to make sure that 60% of the eligible costs are spent on payroll, and then we would probably be building in additional functionality to reach out for the 24-week period to allow you guys additional months to track your costs there. But I'd say those are probably the two big pieces that we would need to update pending this new bill.
Okay, great. So we got a bunch of questions. Well, Sarah, did you have anything to add before we kind of jump towards some of those questions?
Nope.
No. So the neat thing I've learned in the staycation I have working from home and playing games is you make a lot of rules. And, the old days used to be, you rolled the dice and that got to go first. But since I'm the oldest of the three of us here, I'm going to say oldest gets to go first. So I'm actually going to pick the first question. And the first question, Sarah, kind of relates to what we just talked about, that going from 8 weeks to 24 weeks could actually benefit quite a few people. I mean, I know that we have, I've had some correspondence, some discussions with a client that has one of those swim schools where they've been unable to open. And so that's going to give them more time to qualify. At the same time, I have steel distributors and other clients that are going to be pretty much wrapped up at the 8-week period. Will this legislation address, does an 8-week, a company that's going to reach 100% forgiveness at 8 weeks, are they going to have to wait for 24 weeks to apply for the forgiveness application?
So the legislation does include an election. If you want to use the original time frame that was allowed under the original act, you can make that election. So if you are one of those businesses who is able to fully utilize your PPP funds and get 100% forgiveness, you can elect to use the original 8-week covered period. We don't know if this bill gets passed and the SBA starts issuing guidance, if they will allow for businesses to submit their loan application before that 24 weeks is up. If you've used it all on payroll and you reached full forgiveness, we don't know. That's not in the legislation. It doesn't go in that much detail. I imagine that in implementation guidance, it seems logical that they would issue that type of guidance, but that's not there. But for those companies that have reached full forgiveness in the original 8-week period, you can make an election to submit your application under the old rules.
Okay, good. I know going back to our very first discussion on this topic, the big issue was anxiety. You had the anxiety of the application process, getting your application in, getting your SBA number and approval, getting your funds. And now I think people are equally anxious now about how do I get closure as quickly as possible? Okay, so it's good to know that for those on the 8-week side, there certainly would be an option or at least an election to try to go ahead and do that. So Ben, have you been watching the questions diligently?
I have, yes.
Ben, you're the youngest, so you don't get to choose the next question. Sarah gets to choose it. No,
okay, thank you.
Where do you think you want to start here? I see a 16 bagger there. So let's start with the one that seems to be the most upticked, and this is if the Senate passes the bill, the House is already, and the covered period changes to 24 weeks. Will this change the maximum amount of eligible compensation from $15,384 to, I'm going to presume somebody did this math spot on, $46,153.85?
We don't know.
Oh man. Oh, wait a minute. We should freeze ourselves like this.
Yeah, I don't know.
Sure.
Good question.
Yeah.
We have that question as well.
Okay. So I guess when you're thinking about what might come next here, hopefully that's one of the first things that's clarified, because that certainly would impact some of these companies that have a diverse payroll, maybe even have other limitations to who's able to come back at certain times, and also those that have a significant ownership group, because it's any owner. So
it is. Part of me will be surprised if they go as far as to allow 24 weeks worth of payroll. And the only reason I say that is because we're still dealing with a maximum loan value of 2.5 months. That $100,000 annualized payroll. I mean,
right.
I don't know. We'll see where that ends up.
Okay.
Yeah, I had a couple questions from clients on that as well, where in their specific scenarios, they've got pools of employees that can work and pools that can't work depending on their job description. So I think that's a little bit more important for those types of folks, where there's just a certain population of our employees that just aren't going to be able to return to work soon for various reasons. So can we continue paying and using, this loan for the pool that can? And I mean, to a certain extent, if I look at it and I read the loan, I think as long as they stay under that $100,000 annualized compensation for this period, that there may be a chance that they'll be able to just kind of continue paying those people in excess of the $15,384, which really came about from the SBA loan application itself. But to your point, we'll wait for further clarification there.
Okay.
Yep.
Okay.
I wouldn't be surprised to see them put some sort of limiter on the owner payroll, and let the employee payroll sort of roll out as normal. But we'll see where it ends up.
Yeah.
I do want to like sort of circling back, Ben, to your comment about, we have these companies, some of their employees can come back, some of them can't. They have these different pools. They also have pools of employees who want to stay on unemployment because they're making more on unemployment. We haven't touched on that very much in these webinars, but I did want to point out that the WorkShare program for unemployment in Michigan allows employees to come back at 60% time and still benefit from that $600 extra benefit that they get from federal unemployment. So if you have employees that are sitting here saying, hey, I don't really want to come back because I'm going to make less, and there's not a lot of work to do, if you wanted to bring them back 3 days a week, you could do that, and they would still benefit from that $600 unemployment. And they would also get 40% of whatever their Michigan unemployment benefit would have been.
Okay, good. So somebody asked the question of, nearing the end of their 56-day period, they may not reach 100% forgiveness, and this may be redundant to kind of our last discussion. They're basically asking the question, is the best path just to sit tight and kind of wait till we see this legislation? I think in a lot of ways, that's been kind of the mode since day one, even when we had certain clients or certain companies that we might be considering returning the funds if they didn't meet the need. The good faith certification of need. And we kind of said, wait till the very end in case some new rules come out. I would say that that's the case. But at the same time, I think there's still a lot that companies could be doing to start doing the calculations to actually determine and ensure that perhaps, they have or haven't met the full 100% forgiveness through the 8 weeks. But I can't see a reason that waiting and more information comes out, because you still have to ultimately get your information together and your evidence to submit your application. So you're going to have time after your 8 weeks to probably gain new information from either the new law or from continued interim final rules. So that was one of the questions that came up there. I think waiting certainly could benefit. Hindsight, I think in most cases, especially with this, has certainly been a benefit, except for that May 4th, May 5th issue for the foreign-owned subsidiaries who ended up having an issue where perhaps waiting for their application 1 day too long may have inhibited them from being able to apply for the loan itself. Ben, you see another question up there that you wanted to kind of throw out?
Well, I'd say the next highest voted question is actually on how you treat this for accounting purposes and at tax time. So, I don't know if that's something that you want to touch on now, Tim, or you want to wait till next week to discuss that one.
Well, I'll go with the one I saw, and I'm not seeing it right now. But one of the questions what came up is, what do you do with those expenses? Mm-hmm. And I think it's important for people to understand this is not changing your internal accounting. Your internal information, the information that's required to prepare your tax return, the information that's necessary to manage your business, none of this is changing. And I didn't want to get too much into details, but depending on the method of accounting you do nothing until you have full forgiveness of the loan, which is you might have other income down the road, but you'd still have all these expenses that you incurred. And I want to distinguish between the ability to deduct them for your tax return versus the fact that they're a legitimate expense for your business. Those are two different things. This is where your accounting firm, your CPA firm, your Sarah Russell, Ben Smith, or Tim Hilligus is going to know the tax rules when that return comes time to be filed. If you had $100,000 of wages and that $100,000 was a part of your loan forgiveness, you may have no payroll expense on your tax return, but you'd still have it on your financial statement. So it's important that you still track this information within your accounting system. If you're considering the international accounting standards where that would allow you to recognize your expected recovery or your expected income, you might recognize some of that debt forgiveness as other income as you incur these expenses over the 56-day period. So I was at a client's the other day, and we talked about they had 10 days in April that was in the covered period. And the option perhaps could be, this would not be generally accepted accounting principles, but if you're considering a methodology that might allocate that forgiveness to when you incur the expenses on an interim financial or internal financial statement, you'd go ahead and pick up whatever percentage that might be related to your expenses in that 10 days of April when you're closing your April. So definitely something to consider, but this does not just wipe your operating expenses off your P&L. This should be, in my opinion, another item of income. If this was a not-for-profit, I think this would be considered like a grant type source of income, and it'd be recorded immediately, but it wouldn't affect the fact that it's intended to be measured or forgiven against actual expenses incurred. You're going to continue to account for those expenses. How did I do, Ben? My biggest fear is that I just spent 3 minutes talking about that, and then I would finally discover I had the mute button on.
We would have stopped you.
Okay. All right. Thanks for ensuring that you won't just let me go and say, hey, for those of you who didn't hear a word Tim said, it's 100% that he didn't tell us anything wrong if we can't hear him at all.
That would be good that we wait for your mouth to stop moving and be like, Tim, we didn't hear a word.
That's right. Oh, so now I see where we covered that one. All right, what else we got here?
So I think the next highest rated question centers around their company is an S corp. Does the PPP cover owners' benefits, 401k, medical, dental, state and local, or is it just their compensation? The answer to that is yes. The owner benefits would be included, but I believe that there is a limitation based on what those same contributions would have been in 2019.
Well, so this is a quirky little spot here, and we kind of brought this up last week where we said we have to be careful with our answers. Now, thankfully, this was specifically addressed to an S corp. So S corps and C corps would follow the same rule, which means that the owner's benefits are also eligible for forgiveness. But for a Schedule C self-employed individual, that's an LLC taxed as a sole proprietor, or somebody that's not even incorporated and self-employed, and partners in a partnership, their fringe benefits are not eligible for the forgiveness calculation. So that's a unique difference for those two industries. And now we're going to get to the part that I think Sarah and I still may disagree on, and that is the limitation, the $15,385 limitation. And this is really a play on words. This is where you got to read these words and how they define compensation versus payroll costs. So let's just say we're not sure. I'll do it that way, even though I'm sure. What the issue would be for an S Corp and a C Corp, Ben is absolutely right. The one parameter is you can't apply for forgiveness for any more than you paid for those people in 2019. So any owner employee, one of the first limiters is you can't put more in the formula or pay them more in 2020 than you did in 2019. Now, this is where Sarah and I disagree, and that is, I believe the 15,385 limit is strictly for their compensation. They would still be eligible for their 56 days of health insurance, 56 days of 401k match, dental, whatever those items are, Michigan unemployment taxes they might pay. And so that's where Sarah, and this really is an issue of the way commas and sentences are put together in the what's now the law. And I believe it's 15,385 for compensation, and you still get the deduction or the eligibility for forgiveness for the fringe benefits. And I think, Sarah, correct me if I'm wrong, you think the 15,385 is now all encompassing on the total compensation package of an owner employee?
I would say I'm not sure. I would not say with 100% conviction either way.
Yeah.
That's where I'm at.
And I'm just, the only reason I'm confident is because I think it's not as vague as some of the other things they put in this legislation, but it certainly would coincide with what the original rules were, which there wasn't this limitation. So
I agree with that.
If you think about intent or what the expectation was, I'm going to say that, and I see a lot of people ask this question about where do the fringe benefits fall. Well, I can tell you, and I think we all agree, if it's a non-owner, it's 15,385 for compensation, and they still get all their fringe benefits that they would be provided in those 56-day period, or soon to be possibly longer period. Okay. I think there was another question on bonuses or commissions. I think accrued commissions that I saw in there. And sir, I'll throw this question out to you. So we see this a lot in our client practices where they may pay commissions only at certain times of the year. They may give bonuses only at certain times a year, but typically, when you're on the inside of the accounting world for most of these companies, those things are earned and incurred. So why don't you kind of mention what would the issues be for a company who's got incurred bonuses or commissions? What rules do they have to follow? Let's presume it's just the 8-week period. What do they need to make sure happens that they get the most forgiveness?
So the rule in the loan forgiveness application is that, it's paid and incurred, or paid or incurred, to the extent that you have earned commissions that are paid in the next normal payroll cycle, they are includable in your loan forgiveness application. I will say that they have not really addressed variable payments. So there's still that uncertainty. If we remember that the amount of, when you're figuring out whether or not you have a compensation reduction, it's based on the first quarter. And so there's still been no guidance issued regarding if that first quarter of compensation included earned commissions from 2019 or earned bonuses from 2019 that were paid out in that first quarter. Is there going to be any math reduction allowed for that? Because your actual, it goes back to this, how are they defining the term salary and wage? So I think that there's still some uncertainty, and I would say that there's still a little bit of uncertainty around, those commissions that are incurred in your 8-week period and the timing of when you pay them out. If you pay them out in the next regular payroll cycle, will that next regular payroll cycle include, if you pay commissions on a quarterly basis, for instance, and those commissions get paid on the next quarter, or is it going to be really just the next payroll run? I'm not sure. I don't know, Tim, what your thoughts are on that.
Yeah, I think you're exactly right. I think, to me, I have heard, and I think it was yesterday, I had a couple of partners who mentioned that some of their clients were still going to be dealing with what we call this hard cutoff, making sure everything that really needs to be there's no ambiguity. Now, I'm reading somebody put a question up here and said, hey, our bank says we can transfer. I think I want to be careful. As much as we appreciate the bank's involvement in this, in the end, the accounting rules, the tax rules, the banking rules are all going to be dictated by the SBA, and they all could change dramatically as we get through to the end of this thing. So I'd be really careful about absolutes. I'd be really careful about advice with respect to how cutoffs or keeping separate bank accounts or tracing these funds are. I think to be candid, there's risk that everybody faces with respect to some of the advice you're going to get on these things, but definitely trying to adhere to the things we do know, meeting that cutoff of the next eligible payroll, or making sure everybody just gets paid at the end of your 8 weeks. You can try to zip this up as best as you can and put a bow on it, but you might not be able to make it perfect. And
I want to sort of go back to the guidance that was issued on the 22nd. There was some surprises in there, and we didn't really talk about this last week. But one of the things that was in there was, when we go back to the SBA has 150 days to review, it's every loan. It's not, they didn't carve out the $2 million, the ones over $2 million that were going to be under SBA review. It was every loan. And there was still a little bit of, I've read some articles. I don't generally disagree with them. Forbes is usually a little bit doom and gloom on some of their articles. And I don't generally agree with some of the things that they say, but I read an article from Forbes that said, it seems to indicate that they're still looking at liquidity or credit elsewhere. It's clear to me in the CARES Act that they cannot look at credit elsewhere as a determining factor. That is in the legislation. I do not believe that Treasury or the administrator has the authority to change that rule.
Right.
So I'm less concerned about that. But that being said, it has made it clear in the guidance that the SBA, while they will not challenge the certification on loans under $2 million, they still have the ability to review all of the loans. And they certainly don't have the resources to do so, but I think that there will be some level of review, however limited it will be on all loans. The lenders have to send that determination to the SBA, and then the SBA makes the determination and lets the borrower know.
And my guess would be, if this is like anything else in the world that gets audited, they're going to use the information they gather, whether it was a certain bank, a certain industry, certain size, a certain state. If you look at the way these the map allocates these funds, you've got some pretty high dollar amounts in Texas, California, New York, Florida. Those are, I think, the top 4 states from funds. But if you think about it, there's 2 criteria they can audit or essentially review if your loan is $2 million or more, and that is the need and then the actual calculation. If you're less than $2 million, they've safe harbored you on need, but they can still address or review the calculation and determine if you're, what your true eligible forgiveness might be. So those are good points.
And they're going to review not only the loan forgiveness calculation, they also said they're going to potentially review the maximum loan, the loan calculation, how you determine what your maximum loan is. And if they determine that you received more than you should have, the amount eligible for forgiveness will be limited to the amount they deem you should have received. So there is that difference in there too. They're not just saying, hey, we accept that everybody calculated their loan correctly. They're planning on reviewing that as well.
Yeah, good.
So I agree, going back to the original question, while your bank may say, hey, you don't have to track this with great diligence and you can just transfer the funds into the account at the end, I, as a borrower, would probably not want to do that. I wouldn't want to take that risk.
Okay. I got a couple here that I want to address because I'm always worried. So we got a question from Ron that says, does payroll also include healthcare costs? And I'm always leery. It kind of goes back to my days of thinking when clients say, oh, these are my auditors, and we might be just doing their tax return or their compilation or their review. So Ron's saying, does payroll also include healthcare costs? And Sarah, maybe you can start at, payroll costs is a category of things that includes compensation, and so on. You want to kind of,
You can go.
all right.
Go for it.
So payroll costs are an eligible use of these funds, and payroll costs is defined. And within payroll costs, you have compensation. And if you go to the actual act, you'll see what they consider compensation. And so you've got all those variables that you have, your hourly rate employees, your salary rated employees, your commissions, your bonuses, all those things fall in. And by the way, they've determined in the most recent IFRs that those bonuses, those stay bonuses or bonuses you're paying for people to maybe put themselves more at risk, they still fall into that category of eligible compensation. You still got to deal with your limits of $15,385, but for those companies who've paid bonuses to employees to work during this time, those also fall within the compensation category. And then you've got your health care and costs related to that. And it uses the term premiums or the costs associated with providing health care. So those of you who might be self-insured or have certain aspects of your insurance, health insurance that's self-insured, I think those would fall into there, plus your health insurance premiums. I think the couple things we're still not certain about what falls into there, and I've heard different professionals use, well, if I've got qualified plans, I might just say yes. So what I'm going to say I feel is uncertain is the short-term and long-term disability policies. I'm not sure. To me, if I'm thinking of healthcare, if somebody's actually collecting on those policies, now I got to deal with, well, how is that handled from a payroll perspective? Is it a third-party situation or am I self-insured? But from the standpoint of the premiums themselves, I'm not sure. And then the other question we faced probably since day one is the netting of healthcare costs when you've got co-pays, and that's not the right term, but you've got employees who have to contribute towards their monthly health insurance costs. So is the gross amount eligible for forgiveness, or is it the amount after you've been reimbursed from employees? That's still uncertain as far as I know, correct?
Correct.
And the last item that falls into the payroll, last two items that fall into the payroll category, Ron, are your retirement contributions. So that could be matching contributions that occur as you incur payroll, but also any kind of profit sharing or discretionary matching or 401k contributions that you make. And then finally, for Michigan, it would be state unemployment. And for most of our clients, that's going to phase out typically at some point here in the first or second quarters. But if you've had a substantial layoff in 2020, you may actually have where the next time you have a big rehire in your 8 weeks or after, if this goes to 24 weeks, you could have a substantial Michigan unemployment tax due because it's a phase out. And so you may have a significant amount of your workforce that hasn't met that phase out yet. So Ron, hopefully that defines for you what payroll costs are and what those categories of payroll costs are.
I see a question here from Dan, and he's asking, hey, we've received both a PPP loan and an EIDL loan. What guidelines do you recommend to ensure EIDL loan proceeds are not used for the same purposes as the PPP loan as is required? I don't know your thoughts on this, Tim, but I am still a little bit uncertain as to whether or not the EIDL can be used for payroll costs after your covered period. I've read opinions on both sides of that. Some say no, that they can't. To the extent that you can use the for completely separate costs, right? Inventory, purchases, other overhead costs that aren't rent and utilities, anything that's not included in the PPP, I would say to do so, and to, we've already sort of recommended that you put your PPP loan in a separate bank account and you track those costs separately if you can. I'd consider making sure that EIDL loan is segregated from your PPP funds. Mm-hmm.
I absolutely agree. I think that, you think about the three buckets related to this, and you may have other buckets, but you've got buckets you get from maybe your owners lend money into the business, customer collections, you got your EIDL bucket, and you got your PPP bucket. And while those all might be in the same bank account, I think justifying that you have enough sources for funds for the things that would be non-PPP related is going to be pretty important. Again, this is somewhat like your own tax return. For those people under 2 million, you're really auditing. You're really making sure, do I have the right, did I do the right steps? Do I have enough sources of funds for non-PPP items where I was able to pay, certain expenses that don't qualify for uses of PPP funds, inventory, for example, or other direct costs associated with materials or assemblies? Do I have enough other sources of funds to make sure that I'm safe and that I can justifiably trace the use of the PPP funds? And before we get a bunch of questions on this, it's been across the board from the standpoint of some banks absolutely required a separate account, and then you would transfer money in. And to us, that makes all the sense in the world, because the last thing you'd want to do is somehow have a technical hiccup where maybe your PPP loan is swept against your line of credit. And in the end, you end up doing the right things, and you have other sources of funds and things. But the idea was that this money was supposed to be specifically used for these. So it's kind of a self-regulated, checks and balances.
Yeah. And before we get a bunch of questions, because this has come up in other sessions, and for those of you who weren't in the other sessions, I did want to say, a lot of people said, hey, I'm keeping my funds in a separate account, but I'm not paying all expenses directly out of that account, specifically payroll. When my payroll comes due, I'm transferring the amount that's eligible payroll costs into my normal payroll account to pay for those funds. And I think that that's okay, because most companies are going to have unqualified payroll costs going through in a payroll run potentially, especially if you have employees making over that $100,000 annual limitation. So for ease, I think that that's perfectly okay, and tracking how you're calculating that from week to week and how you're sweeping those funds into your normal payroll account, I think that that's okay, as long as you're tracking it.
Good.
I do see a few questions here on this FTE rule that I mentioned that's in the House Act. I'm going to tell you that I don't know how they're going to implement that act, or that piece of the legislation. I can read you what exactly it says, and it's sort of what it says is, if you're unable to return to the same level of business activity as such business was operating at before February 15th, 2020, due to compliance with requirements established or guidance issued by the Secretary of Health and Human Services, the Director of the Centers for Disease Control and Prevention, or the Occupational Safety and Health Administration during the period beginning on March 21st, 2020 and ending December 31st, 2020, related to the maintenance of standards for sanitation, social distancing, or any other worker or customer safety requirement related to COVID-19. There would be an exception on that FTE reduction rule. I do not think that you would get an exception if your customer wasn't fully up and running due to demand, and so you didn't come up to full FTEs as you had before COVID-19. I don't think that would meet those exceptions. However, if you're in a manufacturing facility and in order to maintain the social distancing guidelines, you were not able to come up to your FTEs, I think that you would fall into that exception. I do have a client who, they do live events. Those are clearly on hold due to social distancing rules. And so I think that they would most likely fall under this exception, although I cannot be certain until we actually, first this becomes a law, and then second, we get some implementation guidance on it.
Good. Now I see a long lost relative of mine here, and this is Li Ming He. And for those of you who don't know, my Chinese name is He Di. So, 5,000 years ago, we were all related. So her question relates around they pay payroll twice a month, and would they qualify for the alternate covered period? And we're going to give her a big wah-wah, right, Sarah?
We are. Only borrowers who have bi-weekly or more frequent payroll. So if you only pay twice a month, you're not frequent enough. It's only that bi-weekly or more frequent that qualifies for that alternate covered payroll. The good news is, though, you would still get the benefit of that, you know, to the extent that you have payroll that's getting paid outside your 8-week period. If it was incurred during the 8-week period and is paid in the next pay run, it just falls outside of your 8-week period. You still get the benefit of that.
Yeah. I see Janice has that question, which I think you kind of answered, which is this confusion about they extend it to 24 weeks. And then ultimately I have a June 30, or they extend it, let's say some of this stuff gets extended out to December 31st. And I have a June 30th, like safe harbor date. How do I juggle that conflict? And we just don't know, right?
We don't know. I do see a question here asking about allocate shared expenses between affiliated companies, such as rent, utilities, telephone. The holding company pays the bills. Will there be any issue for forgiveness of allocated expenses since the company asking for forgiveness did not actually pay the expense directly? I know that Tim and I had this conversation with one of our partners. I'm not sure I know the answer to that. They did issue a rule that was clear that affiliated companies could get no more than $20 million in PPP loan. They have yet to issue any guidance that would sort of indicate how that would, you know, how they would apply the rules to those affiliated groups. It would seem reasonable that you could, you know, sort of allocate those expenses to your affiliated groups and take those expenses as long as you could sort of prove where you're at. That being said, you know, potentially if you had an affiliated group that didn't have an employee, there were no employees, it was just rental real estate, that could be an issue. But I think if you have a group of companies that all had employees and they were just set up as separate companies for, you know, different lines of business or whatever, I think that there's probably going to be some method on how to do that. I just don't know what that is yet. Tim, what are your thoughts there?
Well, the one thing I'm struggling with, and I think we faced this question in some past webinars. By the way, it's 4:02. For those of you who are watching, if you got to leave, you got to leave. So we are going to take that liberty. Remember, I asked you all, and you all raised your hands and said, go ahead and go past the time. So we're at 4:02, so we'll probably wrap up here, maybe 4:15-ish. We'll kind of do a quick debrief. But one of the things I'm not certain about is Ben and I have clients who are consolidated groups, and each of the entities had to apply for their own PPP loan. So you're dealing with, well, what is that entity's rent responsibility? And I'm challenged by, I don't necessarily have a lease with a subsidiary and the parent company. And so now, does that just happen to fall off the radar and it's not a qualified expense? I'm not sure. And I think there would be a difference between if the parent company was actually renting a facility that had rent, you know, as opposed to some of the examples we have is the parent company owns the building and happens to charge rent to a subsidiary. So I guess it's a tough one to answer without knowing the specific circumstances. I do think your relationship with your bank is going to be important, and the documentation you put together is going to be important to try to look at that on whether it's an entity layer level or a consolidated level.
Yeah, and I will say, you know, I don't think that the banks were fully consistent on that rule, though, meaning while your clients each affiliate had to apply for their own PPP loan, I have a client that they applied for one at the parent company level only. And the bank had them, that's how the bank had them do it instead of applying for 3 separate loans. So the banks were inconsistent on how you applied for the loan. And I think that they haven't provided us a consistent guidance on how we're supposed to allocate expenses across.
We got another question on the S Corp. Single owner LLC taxes and S Corp. Are the owner benefits eligible for forgiveness? The answer is yes, as long as they don't exceed the amount that was used in 2019. So the comp, you still have the $15,385 limit, but for the owner benefits, you're capped at what they took in 2019. So if they weren't taking benefits in 2019, they didn't get 401k match, or maybe weren't even on payroll, they would not be eligible. That would be the biggest limiter would be the 0 in 2019 would be their limiter for fringe benefits.
I see another question here on how the PPP and the AIDL interact. And it's related to the $10,000 grant that goes against the forgiveness. My understanding on this is that, you just reduce your forgiveness on the PPP loan by that $10,000 grant. And the remaining balance, whatever's left in your PPP loan, flips to the PPP loan terms. And your EIDL loan is separate from that. And you would, if you would just follow the normal EIDL loan terms on that.
Yeah, and the EIDL ends up with two forms of forgiveness. You have, depending on the size of grant you got, which ended up being related to employees, that's that 10,000 maximum. But then all EIDL loans and existing, 704A and other SBA loans, all were eligible to receive and should have been, this is actually an actual forgiveness of 6 months of payments. Unlike what you have with the PPP loan, you have a 6-month deferral. Now I think the deferral goes until you get your forgiveness determination.
Well, so if the House bill passes, I actually didn't talk about that. The House bill includes a revised amount for deferment, and essentially you do not make a payment until you know that the amount of your loan forgiveness. So rather than it being 6 months. And I think that goes back to, it's going to take almost 6 months for the SBA to make a determination in some cases.
All right. Oh, here's anything hot on your eyeballs there, Ben? We got 9 minutes before we.
No, I think we skipped one a few minutes ago. Talking about, again, the 15,385 compensation limit. Does this apply to wages, or and how does that relate to other healthcare and employer payroll taxes? So the 15,385 is cash compensation for the employees, healthcare costs, retirement costs. All that is kind of above and beyond that 15,385 thresholds. There's not a limitation there.
Okay. Let's see what else we got. Oh, hey, why don't we just touch on real briefly? There could be an upside on expenses paid in the covered period but incurred before, but a downside for expenses paid before the covered period but incurred in or after the covered period. You want to go ahead and kind of discuss that for a second, Sarah? And I'm going to, in the last 8 minutes here, I'm going to kind of look through the questions and see if there's anything hot that we should address as well.
I was not, I was doing just what you said you're going to do, so I was not listening to you. Sorry.
Beautiful. So Sarah, I just told you how great I was.
I agree.
And you were just nodding your head. No. Do you want to talk about the cutoff issue, where we talked about this in prior discussions, where there's a positive side on eligible expenses paid in the covered period but incurred before, but there's a negative side to those paid before the covered period but incurred during the covered period?
Yeah, so what Tim is referring to, so for things like rent or utilities, if you didn't pay your rent or utilities that might have been due, say, in March, until you got your PPP funds in April or May, you can include those costs as in your covered costs as part of the PPP forgiveness. However, if you paid your rent or utilities, say on May 1st, and your PPP loan got dispersed on May 2nd, those costs would not be included. So anything prepaid before your disbursement period wouldn't be included, but anything paid late and you waited until your disbursement period would be included. So it's one of the benefits of this incurred or paid rule, and also one of the disadvantages to the incurred and paid rule, right? You incurred the expenses in your covered period, but you paid them outside, they're not included. You incurred the expenses outside of the covered period, but you paid them inside the covered period, then they could be included. Although prepayments inside the covered period are not included.
Okay.
Does that make sense?
Yeah. We got a question from Greg, maybe some confusion on the EIDL loan and grant. And so I'm going to go ahead. He's saying, hey, my understanding is the grant is free and clear and does not have to reduce any forgiveness. Well, there's a couple of moving parts here. If you applied for an EIDL loan, received the grant is you're absolutely correct. You do not have to pay the grant back, and you can certainly then decline the EIDL loan. But if you go forward with the EIDL loan, you'll end up with an installment note at 3.75%, and they'll determine your terms based on your ability to pay. But if you also then applied for and received a PPP loan, this is where they're not allowing you to double dip. So if your PPP loan was $1 million and you got a $10,000 grant, you're only eligible for $990,000 of forgiveness on the PPP loan. So you can't have both. But for some of our clients, all they did was apply for the EIDL loan. They got the grant, and they took no further steps. But any that got the PPP loan will have to consider that grant amount. It could be up to $10,000 in determining their total forgiveness. So hopefully that helps clarify that. And then just the general discussion on any employee or owner who is getting unemployment, and then you determine that you're going to use PPP funds to pay them. At that point, they should no longer be on unemployment. So I think there's some question. I mean, one specific question is a Schedule C or C corporation with one owner. The owner's been collecting unemployment and now is got the PPP loan and ready to go back to work. Well, that's exactly what it was designed to do. You still have to deal with the 15,385 limit, and you still have to deal with the 8-week covered or alternate covered period. So, what I would say is I would not want to be in a situation where I was paying myself and still collecting unemployment.
That's right. As a self-employed individual, I would not want to be collecting unemployment and paying myself with a PPP loan. However, to the extent you have employees, they could potentially stay on unemployment, through that work share program, and your payroll costs, and this goes back in Michigan at 60%. If they were employed at 60% time instead of 100%, they would be eligible still for the $600 benefit under the expanded federal unemployment payments, as well as 40% of the Michigan unemployment, and you could pay them for 60% of the time. So I think that while probably not intended to work that way, that is actually the way the legislation works, is you could have your employees still collecting those unemployment benefits under the work share program and employ them at 60%.
Okay. Let's see. We got 3 minutes. So Ben, you pick something. Or are you typing an answer? I can't tell.
Sorry, I was typing an answer.
Just wake you up? Woke him up.
Yeah.
Woke him up. 4:12, the 4:12 nap. That's why we ended at 4, by the way, a lot of times. Ben's nap time is 4:12.
We had one that came in, Sarah, and I don't know, I think there was something as far as the payroll tax deferment with the Flexibility Act, but I'm not exactly clear on what happened there. Do you have anything to add? I just wanted to see if you could speak for 2 minutes on that.
Sure. So in the CARES Act, one of the parts of stimulus was that companies could elect to defer payroll taxes, and it's for the entire year of 2020. And you will have to pay those deferred payroll taxes back, 50% on December 31st, 2021, and the other 50% December 31st, 2022. The paycheck protection provisions of the CARES Act said, to the extent that you have loan forgiveness, you can't take advantage of this payroll tax deferral. And the IRS came out and issued some guidance that said, if you got a PPP loan, you can take advantage of the payroll tax deferral until such point as your loan has been forgiven, which, potentially could give you, at the time we thought, 4 months of payroll tax deferral, or 4 or 5 months of payroll tax deferral. The Flexibility Act says, even if you get loan forgiveness, you can take full advantage of the payroll tax deferral. So you can defer your payroll taxes starting today, if you haven't done so yet, until December 31st, 2020. It's only a payroll tax deferral for the current year, 2020. So you could get 6 months of payroll tax deferral and pay that back in 2 installments in, on December 31st, 2021, and then December 31st, 2022. I see one question here that says, when do you think the Senate will vote on the proposed legislation? I'd like to tell you that I had some clue in a crystal ball as to what they're going to do. I thought that they were probably going to vote on it yesterday. When they came in, the agenda was clearly judicial nominations and a nomination for the Inspector General on this PPP program. I sort of have C-SPAN in the background generally running throughout the day. It didn't come up today on the agenda. I think they're waiting, if you maybe missed the top of this, I think they're waiting to get full unanimous votes, and there's 2 senators holding it up. And so until they can get those 2 senators to agree to the legislation as is, I think that they probably won't vote on it. They don't want to spend time debating this topic.
All right. Unless you have one more jumping out at you, just leaping out of the screen, I'm going to go ahead and say I've reached my limit of PPP discussion for this day. And so just to kind of remind everybody, we're going to probably keep typing some answers. You probably won't see us, but we'll type some answers, and we will post this live webinar, seminar, whatever. I don't know, there's probably some technical term for what we're doing. But we'll go ahead and we'll get this out to you. We'll also get the Q&As out to you as well. Look forward to next Wednesday. I haven't done this in a while. It reminds me of my CFO roundtable hosting days, which is, we'd love to get your feedback. And, part of the way we look at it is we look at our attendance. Our attendance has been pretty strong. And so that tells us we're doing some things right. But at the same time, we know everybody has different capabilities. We've got professionals on the line. We've got attorneys. We've got other CPAs. We've got bankers. We've got our clients, many who are not our clients. So it's a pretty broad spectrum of participants. So if there's something you're looking for, I would encourage you to reach out. Denise Asker is our director of marketing and pretty much handles and quarterbacks all this for us. She does all the behind the scenes work so that Ben and Sarah can look as good as they do, and I'm kind of stuck where I'm at, but she definitely helps Ben and Sarah as much as possible. I can't do much more. I'm too old.
I don't need any help, Ben or Tim. Come on.
Technical help. But definitely, if you don't mind, shoot Denise a note over at Asker, ASKER at ClaytonMcCurvey.com. It'd be great to know if there's something else you want to look forward to. Again, a reminder for next week. Next week may be very similar to what we're doing. We have no problems answering these questions. I think for some of you who are beyond some of these hypotheticals, it may prove less valuable, but the one thing we want to do is keep next Wednesday open, because I'm more optimistic than maybe Sarah let on. And that's what I've seen our Congress actually function like they should lately, which is get stuff done. So I'm pretty optimistic. I'm going to say I'm very optimistic that I think our Senate could get this to the president before the weekend possibly. And knock wood, it'll help Sarah and Ben and myself actually have some concrete, well, let's say mortar. Let's use mortar. Mortar is a little weaker than concrete. Maybe have some mortar, concrete. I forgot what I was going to say.
I'm pretty optimistic I'm pretty optimistic as well, Tim. Yeah. I hesitate to say it's going to get to the president by the weekend. Part of me wouldn't be surprised to see them continue to haggle over it and not vote until Monday.
All right,
but we'll see.
And I just because his name just popped up. I mean, Superman is on the line. Superman, 36 minutes ago, asked the question, is a government contractor eligible for the PPP loan? He's heard that the SBA considers that to be double dipping. Sarah, do you know the answer to that?
Well, I would say that there's nothing in the legislation that says a government contractor is not eligible for the PPP loan. I cannot tell you that if the SBA reviews your loan, they won't question your need for the loan. And whether or not you really qualified for it. That would be my biggest concern.
Yeah.
Is that you would get reviewed and they would say, we didn't think you really qualified. But the legislation does not exempt you, does not carve you out from being qualified from this loan program.
Yeah. And if I remember right, back in not only the reasoning for the legislation, a couple things that came out were what were all those entities that typically weren't invited into this program? Where did they all fall? And government contractors actually fell into that discussion. Should they actually be eligible? Should churches and other not-for-profits be eligible? So, all right, so let's go ahead. I already lied on the 4:15. We're at 4:20. We're going to go ahead and wrap it up, and we look forward to, hopefully, like Sarah and I said, with optimism. Ben's going to be our naysayer and say it's not going to happen. But Sarah and I believe by next Wednesday we will have a new law, and possibly, can you imagine if we actually had more interim final rules that we could actually digest? That would be, we would be standing ovation for that. And it's not going to happen in this legislation, but we still have to be pushing for this deductibility. I mean, this is a key for those of you who I'll make the math simple. It basically cuts about 30% of the benefit of this loan right out from under you if you can't deduct these. That's if you're flow through entities at a max rate of 29.6. So,
I have optimism that will get fixed. Even though the publicity on that has died way down compared to when the IRS issued that guidance initially, I think the publicity here has been very high on fixing the PPP program first. I was surprised that this specific provision wasn't included in the Flexibility Act, but I have high hopes that they will fix that in round 3 of round 4 of stimulus, which the Republicans have said they expect to be on their agenda sometime in July is when they're going to focus on the next round. And I hope that it will be in there. I have some optimism on that one.
I mean, the hope would be they do it sooner than later. Obviously, it's a moot issue till people got to file tax returns next year. But again, I think it goes to that anxiety to know that that's a tax bill savings you're going to have. It's not a check you're going to write next March or next April. I think is going to be really valuable to any small business out there. So that's it. I'm going to yell out to Brian, our coordinator and technology guru behind the scenes, and ask him to kill the cameras. And we'll see everybody next Wednesday.
Got it.
See you guys.